My taxable brokerage account crossed $100,000 in a broad market index fund. 1 year later, after I shifted into 3 times leveraged ETFs, a commercial mortgage REIT, and beaten down high-yield stocks, the same account was below $79,000. The mistake was not chasing one stock. It was changing a compounding portfolio into a high-risk income portfolio too early. Everything changes after your first $100,000, but the change was not supposed to be me. The portfolio was supposed to become large enough for compounding to matter. I reached my first $100,000, then made the mistake many investors make after a milestone. I changed the portfolio's job. What had been a long-term compounding account became a brokerage portfolio I expected to pay me. I started looking past total return and began thinking in dividend yield, monthly distributions, and projected cash flow from a $100,000 balance. The first money that ever made me feel ahead became the reason I stopped letting compounding do its job. My brokerage account crossed $100,000 after a strong week in the market. The balance was $103,412, almost all of it held in the same broad market index fund I'd been buying for years. The account had been built through automatic transfers from checking. Every month, money left my bank account before I could decide whether the market looked too expensive, too risky, or too uncertain. Shares were purchased, dividends reinvested, and the balance moved according to a process I barely touched. That was the entire advantage. I did not need to guess which sector would lead, which company would beat earnings, or what the Federal Reserve would say at the next meeting. The portfolio worked because I had removed myself from most of the decisions. The first $50,000 came slowly. Most of it was deposits, not investment returns. And the balance still moved more from my paycheck than from the market. Compounding existed, but at that size, it was still too small to feel like the main engine. The next $50,000 felt different. Reinvested dividends became more visible. Market recovery added real dollars, and a normal 1% move started to look like almost $1,000 on the screen. The brokerage account was no longer just a place where I saved money. It had become an asset that moved while I was working. At $100,000, I opened my spreadsheet and created a new tab called Next $100,000. I entered my monthly contribution, expected market return, reinvested dividends, estimated bonus deposits, and a target date for $200,000. $200,000 still looked far away. The first $100,000 had taken years, and the next one did not look fast enough to match the promise I had attached to the milestone. I had heard too many times that everything changes after $100,000, so I expected the account to feel more powerful than it did. The brokerage account had crossed the number every finance video described as the turning point. The portfolio was doing what it was designed to do, but I started judging it against what I thought 6 figures should feel like. I had not sold a single share yet, but I had already stopped seeing the portfolio as a compounding machine. After $100,000, I started seeing it as money that should be doing more. The first sale was $5,000 from the broad market index fund. I entered the order, checked the estimated execution value, and watched a small piece of the position that built the account turn into cash. The new 3 times leveraged ETF looked responsible on the brokerage page. It tracked familiar dividend-paying companies through daily leverage, showed a yield far above the index fund, and had a price chart that made the risk look understandable. Nothing about it looked like speculation, even with the triple leverage inside the fund. The comparison that sold me was simple. The index fund showed a yield close to 1.5%, while the 3 times leveraged ETF showed more than 10%. On a $100,000 balance, that difference looked too large to ignore. I knew a higher yield came with trade-offs. I understood that a higher yield did not automatically mean a better return, and that total return still mattered. But the underlying companies looked established and familiar, and the income estimate made the risk feel contained. The first payment arrived before my next automatic transfer. The amount was small, but the brokerage labeled it as income, and that label changed the way I read the account. That night, I added a new section to my spreadsheet. Market value stayed at the top, but projected annual income moved directly under it. Then I added monthly income, average yield, payment dates, and a column showing what the account could produce if more of the index fund moved into income holdings. Everything changes after $100,000, and this was the first time I could see the change on paper. The portfolio did not need to double for the milestone to matter. It only needed to show me a number I could annualize. The old index position started looking incomplete beside that new column. It had done the actual work, but it did not give me a payment schedule, a yield target, or a monthly figure that looked like output. It gave me total return, but no income figure I could track each month. The second sale was larger. $10,000 left the index fund and moved into 3 new positions. Another 3 times leveraged ETF, a commercial mortgage REIT, and a beaten-down single stock with a massive dividend. Each position had a different explanation, but all 3 offered a higher displayed yield than the fund I was selling. The brokerage account still looked respectable. I had not borrowed against it on margin, concentrated it into one company, or bought anything that looked like a meme stock on the surface. The portfolio was simply becoming aggressively income-heavy, which made the shift easy to defend. What changed was the comparison. I compared the new holdings against each other by yield, payout history, payment frequency, and estimated annual income. I stopped comparing them against the broad market fund by total return, tax drag, volatility, and the growth I had given up. A falling price even started to look useful. When the leveraged ETF slipped after a choppy week in the underlying index, the displayed yield moved higher. Instead of checking whether the total return had weakened, I treated the lower price like a better entry. By the end of the month, almost $25,000 had moved out of the original index position. The account still held 6 figures, but it had more tickers, more payout dates, more fund pages to read, and more reasons for me to open the app. In my spreadsheet, projected annual income kept rising even when the account value barely moved. Nothing in the brokerage account looked reckless yet. The balance was still above $100,000, the holdings still had professional fund pages, and my spreadsheet showed projected income moving higher. That was why I trusted the change. The account looked more organized on the surface, even as it became far more fragile than the portfolio that built it. My first income month gave me the confirmation I was looking for. A payment posted before my next automatic transfer, projected annual income moved higher, and my brokerage account still showed 6 figures. I treated that as proof that my first $100,000 had finally started producing something I could see. Market value started telling a different story almost immediately. Shares of the broad market index fund I had been selling kept climbing with the market, while my new income positions drifted lower, then fell sharply. Cash still appeared in the account, but it was sitting on top of rapidly deteriorating prices. My 3 times leveraged ETFs dropped first. The daily reset meant the products were not just exposed to the direction of the market, they were exposed to the path the market took to get there. In a choppy decline, volatility, drag, and leverage worked together, and the account value fell much faster than the income column suggested. My commercial mortgage REIT followed. Several of its borrowers depended on refinancing conditions, and commercial real estate pressure began weighing on book value while pushing the stock to a wider discount. A large dividend still posted at month end, so I let the payment distract me from the falling share price. My high-yield stock felt easier to defend because it was a familiar company. The core business was deteriorating, but management had not cut the dividend yet. Familiarity did not stop the stock from losing value, while growth stocks led the broader market higher. My spreadsheet helped me avoid the comparison I needed. Projected income barely changed because those funds were still paying, while market value kept slipping in a column I had stopped treating as the main score. Nothing looked broken on screen. My portfolio was just falling behind the fund I had sold. When I finally checked quarter-to-date performance, my income sleeve was down 22.4% after distributions. My old index fund was up 4.2% over the same period. That massive gap should have ended the experiment, but I gave both sides of the portfolio different jobs so I could avoid comparing them directly. The quarter-end numbers changed nothing in my allocation. I left automatic reinvestment on, kept the income positions untouched, and continued directing new purchases away from the index fund. The performance gap was already visible, but I treated it as a temporary setback instead of evidence that the strategy was failing. One fund fell 15%, and its displayed yield pushed well into the double digits. Instead of reading that massive yield as a distress signal attached to a collapsing price, I wrote that the same income stream could now be bought at a better entry. My account was rapidly losing ground. but the yield column made weakness look useful. I added more money after that drop. Not much, but enough to prove I was now using price weakness to support a strategy I had already chosen. The order confirmation gave me more shares, more estimated income, and less exposure to the broad market fund that had built the first 6 figures. By month 2, almost $40,000 had moved out of my original index position. My account slipped below $100,000 for the first time since crossing it, and the drop was too steep for me to call it normal volatility. Still, I told myself the milestone counted because I owned more income-producing shares than before. Each new sale made projected income look better and left less money in the fund that had built my first 6 figures. My brokerage app now had more tickers, more payout dates, more reinvestment settings, and more structural risk for me to monitor. The account required more attention while producing worse results. My quarter-end statement was impossible to explain away. The income positions were still paying, but their total return was trailing the index fund I had been selling all quarter. My account had more activity, more cash entries, and more explanations, but zero evidence that my money was compounding better. Projected income still pointed in the direction I wanted. Total return did not. My portfolio was producing income while actively destroying capital. 1 year after my brokerage account crossed $100,000, my performance tab showed $78,960. Every dividend and fund payment had been reinvested, and every projected income estimate had already been updated in my spreadsheet. Before I changed anything, that same account had reached $103,412. Allocation showed how far I had moved from the original structure. Less than half of my money remained in the broad market index fund that built my first $100,000. Everything else was in 3 times leveraged ETFs, a commercial mortgage REIT, and a handful of beaten-down yield trap stocks I had added after pullbacks. Projected annual income was higher than before, market value was lower, and several holdings showed negative total return even after distributions. Cash flow had gone up, while account value moved violently in the opposite direction. My leveraged ETFs caused the deepest damage because daily leverage magnified each decline in the underlying market. My high-yield stocks started behaving like yield traps. One dividend was cut, another was priced like a cut was coming, and the core businesses kept deteriorating. My commercial mortgage REIT added another layer of pressure as refinancing concerns pulled down the share price faster than its dividend could offset the decline. Each holding still had a reason to exist by itself. Combined, they had created a portfolio that looked organized but destroyed capital. I had not built a stronger version of my index fund. I had built a rapidly sinking account with a larger income column. I rebuilt the comparison using the same starting balance, same monthly transfers, and same bonus deposit. One column showed my actual brokerage account after the income shift. Another showed where I would have been if I had stayed in the broad market fund and kept reinvesting dividends. My actual account was below $79,000. Staying with the old index strategy would have put the account around $118,000. That was the real loss. Almost $40,000 had disappeared from the gap between those two paths. Part came from the aggressive capital destruction inside the high-risk yield assets. Part came from the index growth I missed after selling shares that had continued compounding without me. Taxes made the mistake much heavier. Selling pieces of the index fund inside a taxable brokerage account created realized gains before the new strategy had proved anything. While the income holdings kept throwing off taxable income, I reinvested instead of setting aside cash. Some later losses could offset part of the damage, but the account had still created tax complexity and outside cash pressure at the exact moment its value was lower. After months of treating every payment as confirmation, I stopped letting cash flow push more money into the same allocation. Money moved back into the broad market fund, and total return returned to the top of my spreadsheet. I had restored the strategy after the damage had already been done. Everything changes after your first $100,000, but I changed the wrong thing. I reached the milestone and started treating higher yield as better portfolio performance. My first 6 figures did not fail because compounding stopped working. They failed because I interrupted it.